Okay, good afternoon and welcome back to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be talking about how to hedge a portfolio using options. Now, from my perspective, this webinar is fairly timely given the current geopolitical risks that we're currently seeing in the markets, how late we are into the cycle of the business cycle and going into earnings season. We do have some catalysts. This webinar is really for anyone who has any concerns of the market correcting greater than 3 to 5% anytime in the future, but you want to remain invested in the markets. And there are various reasons why you may want to hedge yourself while still remaining invested in the markets, whether it's because you think that there's a possibility that the stocks may continue to go higher, or perhaps you rely on the dividends of your stocks for income and you want to hold on to those dividends. You don't want to sell your holdings, but you are concerned about a correction. Options provide a great instrument to allow you to hedge downside exposure or mitigate risk. And there are many different ways that you can hedge your portfolio, and that's what we're really trying to cover here today, is to really talk about the best practices for efficiently hedging your portfolio, what tools you can utilize to analyze your hedge, and lastly, determine if it's the right fit for you, because it's not for everyone. So if you decide that all of this, the end of this is to really help you understand what strategies should you choose. And what I really want to make sure everyone walks away from at the end of today's webinar is feeling self-sufficient to be able to analyze hedges on your own using tools like OptionsPlay. We really built this from the ground up to allow you to explore and analyze different option strategies side by side. So today what I'm going to do is I'm going to spend the first half of the webinar talking about the concepts of hedging, because I think hedging is something that most people conceptually understand, but when it comes to practical terms in figuring out what instrument to use, what expiration date, what strike price, that's where it becomes a little fuzzier. I want to make sure that we talk about the best practices around hedging a strategy, and then more importantly, showing you the tools that you can actually use to construct these different hedges and determine what's the best one for you. So before I get started, I do want to say that even though this is a webinar specifically geared for a downside correction, I'm not doing this webinar because I think that the markets are going to correct. There are some cracks that we are currently seeing globally with slowdowns in emerging markets and even here in North America that are certainly concerning and do not line up with equity markets being at all-time highs. However, I do want to say that this webinar is meant to help you prepare for a correction. This is not necessarily to say that we do see an upcoming correction coming. So before I get started, just a quick disclaimer. What I'm talking about here today is for demonstration purposes and education purposes. It is not a solicitation to buy or sell any specific securities. And just for those of you that are brand new to OptionsPlay, keep in mind that you can sign up for the tools that we're going to show you here today completely free of charge by clicking on the link here, which I just entered into the chat window. With that, you're going to get free access to the platform that I'm showing you here today, access to bi-weekly options education webinars just like the one you are on right now, and access to a free on-demand options video library of all the historical webinars that we have hosted and recorded for you, so that you can really go back and view some of those historical recordings for those of you that want to learn more. And lastly, for those of you that do sell options for income, such as selling cover calls and cash secured puts, by registering with the link below, you will get weekly reports on how to maximize your cover call and short put writing. So with that, let's go ahead and get started. Today I'm going to cover quite a few different things, quite a few different topics. First of all, what is a portfolio hedge? I want to make sure everyone is clear, because there's many different ways to hedge. So I want to define what type of portfolio hedge we're talking about here. Then I'll talk about who should actually use a portfolio hedge, because there is a thing called a perfect hedge. And for those of you that have the ability to do so, it is by far a better hedge than what we're going to talk about here today, but not everyone's capable of doing what we consider a perfect hedge. So we'll talk about how to utilize a portfolio hedge. Then what I really want to talk about are portfolio hedging examples and best practices, because like I said, conceptually, most people understand it, but when it comes to the actual practical terms, it gets a little fuzzier. So we want to make sure we define what are reasonable expiration dates, what are the different strike prices you should consider if you're thinking about a hedge, and then more importantly, showing some real analysis using some real-time data to compare the different hedges that we're going to talk about here today so that you can see for yourself which one is best suited for you. So let's go ahead and get started. First of all, let's just define what a portfolio hedge is. It's very simple. It's simple to think about it in the terms of like an insurance policy. It's an insurance policy for your portfolio during a market correction. So effectively what this does is it still means that your portfolio will decrease in value, but the insurance policy will essentially cover some of those losses. And to put on a portfolio hedge, what you need to do is simply to buy a put option on any broad-based index or ETF that closely correlates to your portfolio. And what this will what this will do is, as the markets correct and move lower, you will have a profit from the puts, which will simply offset the losses that you have in your portfolio. So again, when the market corrects and you have a portfolio hedge, your portfolio value will reduce. However, it will be offset by some of the profits that you make from buying a put option. Now, this is what we call an imperfect partial hedge. What that means is that unlike an insurance policy that may pay you may cover a certain percentage or maybe even 100% of the losses that you have on your car or your home, a put option does not always provide you dollar for dollar exposure or dollar for dollar insurance. So you may end up losing $100 on your portfolio, but only gain back $50 or $70 back on your portfolio. So it's important to understand the different hedges that you're putting on and understand what type of coverage you're actually getting, just like an insurance policy. But I will say, unlike buying car insurance or home insurance, buying protection or insurance on your portfolio is expensive. And if you were going to do it all the time, you're going to create a drag on your portfolio that's going to severely underperform your portfolio. So because of how expensive it is to buy this insurance policy or to buy a put option on the market, this requires what we consider active management, and you need to be very timely with your hedges, meaning you can't just buy a hedge and every single month and just wait for the markets to crash. If you're going to do that, it will end up costing you a lot of money. Sometimes it might even cost you more in terms of insurance than you are actually going to gain from the actual markets to the upside. So this is a strategy that really requires a lot of thinking about when to go about doing it and being very tactical in terms of which portfolio hedge you actually produce. So those are the things we're going to go over here today. Is what are those best practices? When should you consider getting into a hedge? When should you get out of a hedge? And then how do you actually select your expiration dates and strike prices? So just a quick illustration of a portfolio hedge. Here is an example of a portfolio, and just like every single portfolio, as the stocks rise in value, your portfolio value will gain in value, and as stocks decline in value, your portfolio will decrease in value. So fairly simple chart to understand. This is your unprotected portfolio, and what it does is it provides dollar for dollar exposure. As the stocks go higher, you make money. As stocks go lower, you lose money. So why the one thing that we're concerned about here is this: as stocks move lower, you will continue to make more, you will have more and more losses to the downside as markets correct lower. So what we're trying to do is protect ourselves against this event when the stocks move severely lower. So how do we go about doing that? We do that by placing a put option. So this is a put option. Many of you are probably familiar with looking at a put option, but effectively what it provides you with is gains as the markets move lower. So put options basically do the exact opposite of your portfolio. As the markets move lower, you actually have gains in the put option. So when you combine the put option with your portfolio, what you end up with is what we call a hedge stock portfolio. Because we call it a hedge stock portfolio because as stocks continue to rise, your portfolio will still continue to rise and you have unlimited profits to the upside. But as stocks decline in value, you will only have limited losses to a certain degree, and at which point you will effectively have a capped losses. So the gains that you have in your put option will offset the losses that you have in your portfolio. So this, as you can see, for many of you that have a keen eye, you will notice that this payoff graph looks very similar to a call option because it really is. It's a synthetic call. And this is one of the things that if you want to learn more about options, this is kind of how we derive put call parity, because you can construct a call using just stock and put, and you can construct a put from just calls and stock. So this is really how we go about pricing options. But that's a whole different topic for a whole nother day. On the portfolio side, like I said, when it comes to a portfolio hedge, there is a thing called a perfect hedge. And for those of you that have the ability to do so, I highly recommend you go ahead and do a perfect hedge because it costs next to nothing and it gives you a perfect hedge. And a perfect hedge is very simple. When you expect the markets to correct, so if let's say the markets are near all-time highs, you think the data out there does not look, is not lined up with where the markets are, you think the markets are going to correct 5, 10, 15, maybe even 50%, the best thing to do if you have the ability to do that is simply move to cash when you expect the markets to correct. And what you want to do is you want to sit on the sides, wait for the markets to correct, and once it has finished correcting, then you want to reinvest into the market after the correction has finished. This is what we call a perfect hedge because it really protects you dollar for dollar to any downside move, and you have no transaction costs. It doesn't cost you any money to move into cash. Or I shouldn't say it's not free. You have to pay the commissions to sell your stocks, and then you have to pay your commissions to buy the stocks. But that pales in comparison to having to buy a put option, which will cost you substantially more than the commissions that would cost you to sell your stocks and then buy your stocks later. However, like I said, not everyone has the flexibility to do that. Perhaps you have concentrated positions where you have a really low tax basis. You don't want to sell your stocks. Maybe you rely on some stocks for dividend income, so you don't want to lose that income stream. There are various reasons that users may have equity investments that they cannot move into cash, but they are still concerned about that correction. So if that's who you are, and you're an investor with a portfolio of stocks and ETFs, and you want to protect yourself against a correction greater than 5%, and you do not wish to sell any of your holdings, that is when you want to consider buying a put option on your portfolio. So again, be very clear. If you have the ability to move into cash, that's a far better hedge than having to buy a put option. But sometimes that's not always an option. And if that's the case, that's when you want to use a hedging strategy. So when it comes to placing a hedge on your portfolio, this is really where we want to talk about when should we enter. So like I said before, and I will give you some examples of this in a little bit, but buying put options are extremely expensive. So when you're thinking about putting on a hedge, generally speaking, you want to enter this put option or buying the insurance on your portfolio during a correction, not before a correction. And I know that sounds a little counterintuitive, and many people will say, well, if you bought it before the correction, it'll be cheaper. However, what I'm going to say is that 8 out of 10 times, if you end up buying puts early, you might end up buying puts well before a correction, and it might take weeks, if not months, before the correction actually happens. And during that time, you're losing 2, 3, 4, 5% of your portfolio just to pay for that insurance for something that may happen. Versus you can buy insurance during a correction. It'll cost you a little bit more, but at least you're not buying it in anticipation of a correction and losing 2, 3, 4, 5% of your portfolio waiting for that correction to happen, even though it might be relatively cheap. Second of all, when you should consider exiting a hedge is simply when the correction is over. And for many people who are asking the question, how do I know if a correction is over? This is really where you can see if volatility peaks. So in Canada, you guys have an S&P TSX 60 index. There's even a VIX index on that S&P index. If you look at historical VIX indices, they tend to peak near market bottoms. So you can use the VIX index on the S&P TSX 60 as your indicator as to when it might be time that the correction is over. These types of corrections will usually result in a peak in volatility, and that's how one of the ways that you can utilize a timing indicator to get out of a hedge. So now that we talked about entry and exits, now let's talk about hedging instruments. So this is really where what you decide to buy a put on is heavily dependent on what your portfolio consists of. So you generally want to pick an index that's correlated to your portfolio. So if you have a broad-based, well-diversified portfolio in Canada, then you generally want to use an ETF like XIU, which is the S&P TSX 60 ETF. This is for broad-based diversified portfolios. But I talk to a lot of you guys, and you guys have some concentrated position many times in certain sectors or certain types of stocks or certain concentrations. So this is really where you want to pick an instrument that closely aligns with your portfolio. So imagine if you had to replace the individual names in your portfolio with a single ETF or mutual fund. What would be the closest constituent to what you currently have in your portfolio? And that's a good way to think about what ETF should you use. So if you have, in Canada, a lot of people have banking stocks. So if you're concentration in banking stocks, you might want to use an ETF like XFN, which is a financials ETF, or an ETF that has a lot of the Canadian banks included. Many of you now trade marijuana stocks and have a large amount of exposure in those. And perhaps sometimes you just want to hedge the downside in marijuana stocks. Marijuana stocks have certainly taken a hit over the last few months. So maybe you want to hedge some of that exposure. And this is really where you want to, again, look at the makeup of your portfolio and look for ETFs that are similar to your portfolio. That's usually a good starting point in picking a hedging instrument. So once you've picked a hedging instrument, now let's take a look at how do you actually go about calculating a few different things. So first of all, we want to take a look at how many contracts does it take to actually hedge your portfolio. This is a really simple formula, and OptionsPlay actually calculates it for you, so you don't have to memorize how to do this. I will show you how to utilize our tool to do these calculations, but it's very simple. You take the value of your portfolio, and this means the value of the portion that you want to hedge. So if let's say you have a $100,000 position, $100,000 portfolio, but you have $20,000 worth of marijuana stocks and you want to hedge those marijuana stocks, then you would only take the $20,000 proportion that you have marijuana stocks to calculate this particular formula. So you take the portfolio value, whether it's $100,000 for the whole portfolio or the $20,000 for just your marijuana section of it. You want to take that portfolio value, divide it by the index value or the ETF value, divide that by 100, and that gives you the number of contracts that you need to trade in order to hedge your portfolio. And I just have a really, really simple example here of a different size portfolio and looking at XIU, which is a broad-based ETF based on the S&P TSX 60 index. It's currently trading just around $25. So if you have a $20,000 portfolio, you take $20,000 divided by the $25 that the ETF is trading at, divided by 100, and you'll see that you need to trade roughly 8 contracts. And depending on the various portfolio sizes, you're going to need more and more contracts in order to hedge your portfolio. But very simple calculation. Like I said, you don't have to memorize this. OptionsPlay actually does these calculations for you. So now let's jump into what I think is probably the most important thing, is picking expiration dates and strike prices. So when we're picking expiration dates, generally speaking, like I said, buying insurance is expensive. Not only is it expensive, when you buy any type of calls and puts, you have time erosion working against you. And that is actually what creates the drag on your portfolio as you wait for the markets to correct. So not only do you want to, number one, have your trades be relatively cheap, more importantly, you want to make sure that the time decay is as slow as possible, because the slower the time decay, the less drag it produces on your portfolio. So the goal here is to really minimize time decay. And generally speaking, longer dated options will give you that lower time decay. So what this means is that if you're trading options for hedging purposes, you generally want to stay away from weekly options. You don't want to select weekly options because of how fast this acceleration happens in that last month. If you are trading hedges, what you generally want to focus on is more so a monthly option, somewhere in this 1 to 4 month time frame. Generally speaking, we usually tell you to go at least about 2 months out, because the time decay during this time frame is much slower. The slope of that green line is much lower than the slope of that red line. You want that slope to be as short as possible. And then you could even argue that you want to go even further out in time because the slope is even lower. However, I will say the further out you go in time, the less liquid the options are, the more expensive they generally are. So that's why we think the sweet spot is usually somewhere between 2 to 4 months out. Most corrections happen over a relatively shorter amount of time. Only very, very few corrections take longer. And if they do take longer, you can always buy more puts or puts at a lower price as the puts have already made money. You can roll those puts. But generally speaking, 2 to 4 months out is usually a good starting point for buying protection or buying insurance on your portfolio. So lastly, strike prices. This is really where it really varies across the board, but I'm going to talk about 2 different types of insurance that you can purchase. And I want to equate it to terms that many of you that own home insurance or car insurance may be able to relate to, which is 2 types of insurance: catastrophic insurance and comprehensive insurance. So catastrophic insurance, just like medical catastrophic insurance, it's meant to provide you with coverage in some kind of major accident. So in this particular case, a major downside correction. So catastrophic insurance is, if you expect, you're not too concerned about small fluctuations in the market. So the market moves 2, 3%, 5%, you're okay. You're really trying to prevent this when the market melts down 20%. You're concerned about something like that. Catastrophic insurance is suitable for that. This is where you want to buy out of the money puts. So usually about a 30 to 40 delta is a good starting point. And generally speaking, with these types of parameters, this will really cost you roughly 1 to 3% of your portfolio value. So quite expensive. Imagine buying a 2-month protection on your $1 million home and costing you anywhere from $10,000 to $30,000 just for those couple of months. That would be crazy to pay those types of insurance premiums. But that's how expensive insurance on your portfolio is. So if you have a $1 million portfolio, you should expect to pay somewhere between $10,000 to $30,000 to protect your portfolio for a couple of months. On the flip side, comprehensive insurance will provide you with coverage in any downside correction. So even a small correction, you'll get quite better coverage. This is where you want to buy in the money puts. So about a 50 to 60 delta put is a good starting point for comprehensive insurance, and this will cost you even more, about 3 to 5% of your portfolio value. So on a $1 million portfolio, that's about $30,000 to $50,000. So a lot of money to buy protection for just a short amount of time. So again, that's why it's so important to understand how to go about timing these so that you're not buying protection early. Imagine buying $10,000 or $20,000 of protection for 2 months and then the correction never happening and you lose out on that $10,000 to $20,000. That would certainly hurt. Even though that's still a relatively small percentage of your portfolio, that would certainly hurt. So what we want to do is help you prevent that by simply buying protection when the actual correction starts to happen so that you're not buying in anticipation of a correction. So with that, just a quick a few tips on hedging and some best practices before we jump over to OptionsPlay to show you some real examples. So number 1, constant hedging is not cost efficient. Like I said, it's very, very expensive. So in this particular case, this is one of those times where it's actually better to be late than early. It's better to be late because insurance certainly will be a little elevated, a little bit more expensive, but you'll generally get good coverage, and you're not buying insurance when you don't need it. One of the ways that you can offset the cost of buying these puts that are quite expensive, especially when the markets are correcting, is to sell cover calls on the stocks that you own to offset your hedging costs. This is sometimes called a collar strategy. And then lastly, for those of you that do have the ability to trade index options, sometimes they do have some cost efficiencies in trading that versus ETFs. And lastly, and I will show you why I say this, but those in-the-money puts, the comprehensive insurance, will provide far better protection on your portfolio than that catastrophic insurance. And many times when we're buying insurance, we tend to go on the cheaper side. And this is really one of those cases where, you know, you get what you pay for. And what I want to do is I want to show you some examples and show you why that is the case. So for that, what I'm going to do is I'm going to jump over to OptionsPlay. I want to show you how to utilize our tool to analyze these types of strategies, and more importantly, be able to show you the difference between that comprehensive and catastrophic insurance. So this is OptionsPlay. For those of you that are brand new to OptionsPlay, welcome. This tool is really designed from the ground up to make your options trading experience as intuitive as possible. So it's divided into 3 sections. You have trade ideas and watch list here on the left-hand side of your screen. In the middle is your security analysis panel, and on the right-hand side is trading and income. So today what we're going to focus our attention on is the trading tab, and I want to show you how to modify the trading tab to look at some hedging opportunities. So first, I'm going to use XIU because this is the broad-based S&P TSX 60 Index ETF. For those of you that have a broad-based, well-diversified portfolio, I want to show you how to utilize this tool to set up 2 hedges and compare them. And then if we have time, I will set up one for either financials or maybe marijuana to show you some of that. So XIU is trading just at $24.86, just around $25. What I want to do is I want to construct 3 strategies here on the right. The first one, I'm going to mimic the portfolio that we have. The second strategy, what I'm going to do is I'm going to modify them, and I'm going to select a put option. So here what I'm going to do is I'm going to select a September or December. Let's say I selected December, which is roughly 2 months out, and I'm going to select about a 24.5 put option. So this is the out of the money put option. And the second strategy, what I'm going to do is I'm going to select the same September, but I'm going to use an in the money call option. So I'm going to use a 25.5. So here I have 100 shares, $2,400, a 1 put option that cost me $33, which is the catastrophic insurance, and I have a in the money call put option which cost me $70, the comprehensive insurance. Now, before we actually start looking at these 3 strategies and comparing them, what I'm going to first do is use our risk and investment calculator, which is the 3rd dot, and I'm going to enter my portfolio value. So let's say for now I have a $50,000 portfolio. So what I see here is I have a $50,000 portfolio, which is mimicked by 2,000 shares of XIU, which as you can see is just roughly about $50,000. Here I'm going to buy 20 contracts of the catastrophic insurance, which will cost me $660, and I will buy 20 contracts of the comprehensive insurance, which will cost me about $1,400. So notice that the comprehensive insurance is almost double, or roughly double, the cost of the catastrophic insurance. So let's compare these 3 strategies and see how the market performs and how these strategies perform based on different outlooks on the underlying stock. So again, this is for a September expiration. So if we look at the markets right now, just a quick snapshot of the markets, as you can see, we kind of have had this double top form at here around $25. Market top there in April, fell down, corrected back to about 24, rallied back up to just shy of that 25 level, or just around 25 before bouncing lower a little bit. If you look at the U.S. equity markets, we've already made all-time highs, or we've broken above that April high. So perhaps at this point, I still think that this market still has some room to grow, considering the fact that we're entering earnings season. The bar has certainly been lowered a bit during earnings season, so I think companies have a higher chance of beating earnings. So I'm not, again, overly bearish on this particular market, but the fact that we have this double top that's formed that has not broken above that, there could be risk that this market pulls back, let's say, modestly to $24, but maybe even back down to the support level around 23, 24 over the next couple of months. I think that is a reasonable concern for someone to have. But again, that's not my outlook, but let's just say those are the different scenarios we want to take a look at. And just in case this market does rally, we want to take a look at what happens if this market makes an all-time high. So first, what I want to do is I want to take a look at this portfolio or these set of portfolios if the market stays exactly where it is on expiration date. So let's say the market stays flat, maybe it goes a little higher, a little lower, but September comes around, it's still trading just around this 24.86 level. So as you can see, my stock portfolio would be flat. That's reasonable to expect if the markets are flat. If I bought this catastrophic insurance, it's very cheap, $660. As you can see, if the market stays where it is, I lose everything. I lose $660, which is expected if you buy a put and the market doesn't move any lower. Conversely, if you look at this comprehensive insurance, it costs me substantially more money. I would expect that I would lose more money because it costs me more. But notice how I'm only losing $620. So granted, this is not a great result for any strategy, for any hedging strategy, because you've lost money when the markets are flat. But notice that even though the comprehensive insurance costs substantially more, you actually lose less money if the market doesn't move anywhere. And that's the first thing that I think is surprising for most users when they think about hedging, is that most of us don't think about buying an in-the-money put or an in-the-money option when we're thinking about hedging. But those in-the-money options, because they have intrinsic value, they don't lose as much if the markets don't move. So you actually lose less money. So your net result here is that even though it costs you double the amount of money, you actually lose less money if the market doesn't move any lower. So next, let's say the market does correct a little lower to 24.5, right? So this is a very small move. I would not call this a move that would require a hedge. But if it does happen, as you can see here, if I lose about 1.5%, which is about $700 on my portfolio. But in the catastrophic insurance, I still lose the $660 because I bought an out-of-the-money put. This market really needs to tank in order for this catastrophic insurance to kick in. So not only do I lose $723 on my portfolio, I lose an additional $600 on my catastrophic insurance. So now, instead of being down $700, now I'm down almost $1,500. Conversely, on my comprehensive insurance that I've paid a pretty penny for, I now make $100 back. So instead of losing $723, I only lose $600 roughly. So as you can see right off the bat, the comprehensive insurance provides far better coverage even in a small move. So 1.5% move is not what I would expect to buy insurance from, but this is just to illustrate even a small move, you're still going to get coverage on that very expensive insurance versus the catastrophic insurance will put you in a bigger hole. Conversely, if the stock moves down to $24, which is what we said, this is, $24 was that low back here in June. So if it does have a big move down here, which is a little over 3% move, I lost $1,700 on my portfolio. As you can see at this point now, the catastrophic insurance starts to kick in a little. I make $340 back. So instead of losing $1,700, I lose roughly $1,400, $1,300 or so. So it starts to cover some of my losses as the market starts to correct. But as you can see, my catastrophic insurance covers me $1,100. So out of the $1,700, I recover $1,100 back. So instead of being down $1,700, I'm now only down about $600. So again, catastrophic insurance, far better coverage even in these types of small moves. But if I do get this big move to the downside to 23 or so, even 23.26, which is that major support level we see here back from early January. As you can see, I'm losing $3,200 on my portfolio versus where I'm getting $1,800 back. So it's certainly starting to perform. I'm still down roughly $1,400 in this net with my catastrophic insurance, but at this point, I would certainly say the catastrophic insurance is doing its work and providing you with some hedging to your protection, to your portfolio, but the catastrophic insurance covers me almost fully. So I'm losing $3,200 on my portfolio, but I'm gaining $2,500, $2,600 back. So I'm only down roughly about $600 as opposed to $3,200. And that's what that $1,400 comprehensive insurance provides me with. So as you can see, even if the market stays where it is, moves a little lower or moves substantially lower, the comprehensive insurance, the one that costs double the amount of catastrophic insurance, provides me with full coverage across the board, even if the market doesn't really move anywhere, even though it costs substantially more money. However, if let's say the stock does rally, let's say it rallies up to 25 and a half, new all-time highs, that's really where I'm starting to underperform with the catastrophic insurance, because now the market's up $1,300. I'm making $1,300 in my portfolio. Here I've lost $660 to my catastrophic insurance. It's relatively cheap, so I give up half of the gains that I have in my portfolio, versus in the comprehensive insurance, I've given up all my gains and a little bit more. So if this market rallies to new all-time highs, this is where I've lost $1,400 in addition to the $1,200 that I've made. So my net is I'm down about $150, $200 or so. So this is really where the comprehensive insurance really underperforms here. However, what I will say is that when you buy this type of insurance, when you buy a $1,400 in the money put, if the market doesn't correct and it starts to move higher even a few days later, so if the stock goes up to, let's say, $25, and maybe right now we're in mid-July, so let's say by mid-August the markets have moved up to 25. So a whole month later, the market hasn't moved lower, it's just sitting sideways, maybe even moving a little higher. Notice how these two options are very, very similar, which means that you've made some money on your portfolio, you've lost some money on your puts. At this point, I would say that a month has gone by when I expected the markets to correct. It hasn't happened. It's time to get out of your hedge. Buy back sell your puts. As you can see, the difference between the comprehensive and the catastrophic insurance is roughly the same. I'm not risking much more on my comprehensive insurance, even though it cost me double. So this is really some of the scenarios that you should consider. And this is why when I'm hedging my portfolio, I will typically look more so on the comprehensive side versus the catastrophic side, even though for most users, they tend to lean more towards the catastrophic side. And lastly, if I'm concerned about how much I have to pay, that's when I will come to the income tab, and I may want to consider selling some cover calls. XIU unfortunately doesn't provide a lot of income, but as you can see, I can sell a 25.5 for about 15 cents. A call option, so that will offset a little bit of the cost, because I can sell an out of the money call when I'm bearish on the markets, or I can even get a little bit more aggressive, maybe even sell a 25 strike call for 26 cents to offset the cost of buying that put option. So those are some of the ways that you can offset. XIU, unfortunately, not a lot of premium, not much to do there, but you can still offset some premium. So lastly, before we jump over to Q&A, I just want to do one example of marijuana. Now, I'm bringing this up as this market has really collapsed over the last few months. You know, if we were talking back here when it was at $23, this is probably a much more interesting trade. You know, this market has really tanked from that 23 down to about 16 or so, 17 or so, and it just looks like it's near support. So this might not be a very timely I would say a webinar for this, but if the market does rally back up to that 22.1, 23 level, and you are concerned about a correction, because we have seen some of these spectacular crashes from 24 all the way down to 16 in the matter of half a month or just a few weeks, this is really where put options will shine. So again, if let's say I have 100 shares of HMMJ, and let's say I buy a put option here, let's look at the September's again. Let's first look at a 16 as a catastrophic insurance, and then let's look at the same, maybe the 18s as the comprehensive insurance. And again, let's say you have $20,000 in marijuana stocks. So here, my $20,000 marijuana portfolio is roughly constructed about 1,100 shares of HMMJ. I can buy 12 contracts of the the catastrophic insurance, which will cost me $1,000. 12 contracts of the comprehensive will cost me $2,300. So more than double the catastrophic insurance. So let's take a look at this. If the market stays just where it is, around 16 or so, it looks like this stock is around 1706. It closed around 1706 today. So if that happens, as you can see, my portfolio here is flat. I've lost $1,200, everything that I've paid for on the catastrophic insurance. Even though I paid $2,300 on the comprehensive insurance, I'm only down $1,200. So these two are fairly even. This certainly will come out slightly worse, even though it costs substantially more. So obviously this doesn't work very well if the market doesn't move, but if the market does tank to that $13 level maybe, which is where it was when it broke below this last $16 level. So if we do get a revisit of that 1330 or so, as you can see here, I've lost $4,400 in my portfolio, a 22% loss. I gained back $2,200 with the catastrophic insurance. I gained back $3,300 with the comprehensive insurance. So the net difference between these two is about $1,100 difference, which is roughly what I'm paying. I'm paying an extra, what is it, $1,300 or so. In exchange, I'll make about $1,100 more. On this. So this is really what you're going to be able to get if you're buying these types of insurance policies. Conversely, if the market corrects a little bit lower to maybe 15, as you can see here, I'm lost $2,400, but I'm only making $180 back on that catastrophic insurance versus $1,200 back on the comprehensive insurance. So instead of down $2,400, I'm only down about $1,200 for this strategy, versus here I'm down roughly about $2,200. So this is really how you can utilize this tool to construct any portfolio. You can just type in an ETF that you think closely mimics your portfolio, construct 2 put options, usually an out of the money and an in the money option, and then you can use our P&L simulator to say, well, what happens if the market moves higher? What happens? How much money do I lose? If the market moves lower, how much money do I gain? And you can utilize these tools to allow you to quickly understand how these strategies perform so that you can make an educated decision as to what is the right hedging strategy for your portfolio. And I hope that this illustrates to you a couple of things. Number one, buying protection is not cheap. So be very careful about when you go about doing this. This is not something, again, that you should do when you anticipate a hedge. When you anticipate a market correction, you should do it as the market corrects. So what I mean by that is, really, for example, when this market broke below that 21 level and the market started to really, it was pretty clear that this trend here has turned lower. So if we look at our trend indicators here, it was here in April 8th when both the 1 month and 6 month trend indicator was all green here in late March 26th. And then by April 6th or April 8th, about a week later, things have turned pretty sour. That's when I would have considered buying that hedge. Or you could even been more conservative, waited till the 15th, which is when the market really tanked from about 21 down to 19. That's when you could have put on a hedge. And even if you bought a 2-month hedge and this market went all the way down to 17, you probably would have made a nice hedge for your portfolio. So you can use our trend indicators to really give you a sense for when things have turned. So when you have this green indicator that shows you everything's green, once it starts to turn lower and the trend quality starts to deteriorate, that's when you want to consider entering that hedge. And then you want to wait for the volatility to peak, which if you look at a VIX indicator like the VIX TSX 60, you'll see that they probably peak somewhere down here around that 16 levels. That's when you can figure out when it's time to take off that hedge. So with that, that goes over what I wanted to show you here today. What are the best practices for putting on a hedge, what you should be looking out for, and what type of expiration dates and strike prices are suitable for that. So with that, I want to thank everyone for taking the time out here this afternoon. I really hope that you guys have found this useful. And again, to sign up for the tool that you see here today, you can register at optionsplay.com/TMX, which I just posted in the chat window. At this point, what I'll open this up is for Q&A. If you have any questions, please feel free to type them into the chat window or the Q&A window at the bottom of your screen, and I'll answer as many questions as I have time for here. Neil is saying, how about selling a cover call to finance the put, making a collar hedge? Yes, that's exactly what we spoke about. And it's absolutely a strategy that you should utilize, especially if you're bearish. Because if you're bearish, selling that upside call should be a no-brainer, because you effectively are saying, I don't think the market's going to go any higher. Let me sell off that upside. Use the premium that you received on that cover call to pay for that put option. So that is one of the ways that you can reduce the cost of a portfolio insurance. Dennis is saying, is buying bi-directional options good without buying share good? Dennis, I'm not sure what you mean by that. If you could clarify, I'm happy to answer that question. Morley saying, looks like an inverted head and shoulders. I'm not sure if you're referring to XIU or the marijuana ETF. If you could clarify, I'm happy to take a look. Matthew's saying, great webinar, Tony. Again, I will now start using the VIX index as a good indicator to time my exit point. Great. I'm glad you were able to learn that. Morley saying XIU. Okay, let's take a look at XIU. Is XIU an inverted head and shoulders? So an inverted head and shoulders requires first a sell-off into the head and shoulders. You usually don't have an entry from the downside into an inverted head and shoulders. So yes, I would agree with you. If you were only looking at this portion of the chart, this does look like an inverted head and shoulders. But an inverted head and shoulders requires you to first start from up here, enter the head and shoulders and then eventually exit the head and shoulders. That gives you that buy signal. So you're absolutely right on the formation itself. The only caveat is the fact that it did not enter from the right side. Whoops, let me clear my drawing tools. So that is just a textbook classic definition of head and shoulders. You can certainly do your own interpretation and say, hey, we go from left shoulder to right shoulder, from high volume to low volume. It certainly seems to have everything else that I would typically see of a head and shoulders. And I agree with you that I think that this is the formation of a potential breakout above 25. Just that it doesn't fit into the classic head and shoulders definition. Charles is asking, could you use a straddle since you're not sure when? Charles, a straddle would cost you even more, and I would not think a straddle is suitable, because a straddle would simply mean that you're doubling the cost of your insurance, which makes it even harder to overcome. And you really need to have the market to move a substantial amount in order for you to be able to make money back on your straddle. So I would not suggest that you use a straddle for hedging a portfolio. Are there any ways to use options to hedge currency risk? Absolutely. So you can use, there is a USX index option that you can utilize to hedge currency risk. I guess it really depends on which currency you're referring to. If you're talking about dollar CAD, that's one strategy that you can use. And depending on whether you trade other markets, because if you trade futures, you can access options on futures. There are a lot of instruments that you can use to hedge currency risk. You can use index options that are on the US dollar Canadian that you can actually use to hedge your currency risk. Could you use a straddle? I think I just answered that question. Sunita is asking, do we have access to the platform you are using where you can manipulate the calls and puts and see the price? Absolutely. So the link that I just sent in the chat window, that's how you use to register. It's free of charge to all Canadian residents as a courtesy of the Montreal Exchange. You guys all have access to the Canadian version of OptionsPlay free of charge. You just have to sign up using the link that I just sent to everyone in the chat window. Debbie's saying, best place for website or book to read for a beginner? Great question, Debbie. Let me see. I do have a recommendation on that front. I just got to bring it up 1 second. I believe it's called Understanding Options from Michael Sincere. Here we go. It's this book. It's Understanding Options, the second edition. I'll send a link to everyone in the chat window as well. It's authored by a guy named Michael Sincere, who actually happens to be a member of OptionsPlay. I've spoken with him a few times. I like his writing style. I like how he simplifies options the same way that we try to simplify the options experience for you. So I really encourage users to take a look at his book for trading options. Yeah, exactly. Not about hedging, just talking about general options, understanding puts and calls, and how to just look at options as a whole. So not specific to hedging. I just sent the link to everyone in the chat window. Bradley, thank you so much. I really appreciate it. I hope that the catastrophic versus comprehensive insurance piece makes sense to those of you that have to buy insurance on your car or your house or even medical insurance. That's the best way I can, make an analogy out of that. Any other questions? Thank you so much. I really appreciate it. If there are no other questions, I just want to, how about exit and sell a put? Not sure what you mean by that, Roy. If you can clarify, I'm happy to answer that question. Azim, thank you so much. I really appreciate it. If you're late, that's okay. This webinar is recorded. We will send you not only the recording, but also the slides. Thank you so much for participating at Wealth 365. I will also be there tomorrow morning at 10 a.m. for those of you that will be part of Wealth 365 or going to that conference. How do we see both the 1 month and 6 month indicator to start the put? Again, the 1 month and 6 month indicator is just letting you know whether the trends have started to turn. So here's XIU. As you can see, during that rally up, trends were 1 month and 6 month trends were green the whole time. And things started to turn a little bit here on May 7th. When things started to turn a little bit, that's your first indication that maybe things are starting to turn lower. And that's really how you can utilize the 1 month and 6 month trend to time your hedges. And what I'm basically saying is that if things are still green, it's too early for you to buy protection. Roy is saying put at lower price of exit to get back in. Roy, I'm really sorry, but I'm not sure I understand. Are you referring to buying the put and then exiting at a lower price to get back in? I'm sorry, but I'm not sure I understand your question. Wallace, Surin, Francois, thank you so much. Roy, if you have a specific question regarding that, you can send me an email at info@optionsplay.com. You can tell me the exact scenario you're thinking about and what your question is, and I'm happy to answer those questions for you. With that, I just want to thank everyone for taking the time out here this afternoon. I really hope that you guys have found this useful. I will send the recording out to everyone in about half an hour. So look out for that in your email, and I'll see you guys in 2 weeks.